Now here in this class we are talking about Gordon's model, means we are still continuing with Gordon's model, but we are going to observe the impact of dividend growth. This is having no complication, it is quite simple, but let us try to understand it. Gordon's model takes into consideration the effect of dividend growth, which can significantly impact the valuation of a stock. When dividends are expected to grow at a constant rate, the intrinsic value of stock increases. This is because future dividends are projected to be higher, making the stock more valuable to investors. Conversely, if dividends are not expected to grow, the intrinsic value of the stock is lower. This reflects a scenario where the future cash flows remain constant and do not increase over time. I want you all to quickly take note of this whole thing and then I take you ahead. Alright friends, once we have completed writing this whole thing, let us move on to a very good example to understand this. The first example in this category, it says dividend paid by X Limited in the current year, $15. So it is dividend paid by X Limited in the current year. So it is not a D1, it is basically D0, correct? This is D0. Equity capitalization rate is 20%. You are required to determine the present value of equity under the following situations. Number one, if the dividend per share remains constant, that means there is no growth involved. And number two, if the dividend per share constantly grows at 12% per annum. Also show the increase in value of equity because of growth. Now, how will you attempt this question? See, for solving this particular question, what you just need to do is, you need to understand that you have two scenarios. One is where the dividends are not growing at all, and another where the dividends are growing at a constant rate of 12%. So, the Gordon's model application will still be same, that is P0 equals to D1 divided by K minus G. You have to apply the same formula under both the scenarios. The only difference will be in one particular case, that is the first case, growth rate is 0. In the second case, there is a constant growth rate of 12%. So you will be obviously finding that the scenario where growth is considered, the value of the shares will be higher. And when you find the value of the shares is higher because of growth, then you have to also mention how much excess value or how much additional value the share can obtain because of the growth factor. So you would compute the difference in the present value of both the situations to show the impact of growth in dividends on the value of the shares. I am sure you people are clear with what you need to do. So let me take you ahead with the presentation of the solution for this example. Look at this. First scenario, if the dividends per share remain constant, that is to say dividends do not grow, P0 will be D1 divided by K minus G. You define these variables. D1 will be expected dividend receivable by year end, that is continuing to be $15. Why? Because there is no growth in dividend. So D0 was $15, D1 remains $15. KE will be your equity capitalization rate. P0 is the current market price of equity share that you want to determine, and growth rate is 0. So when you make the computations, P0 value comes to $75. So write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and take up the next part of the calculation, that is, if the dividend per share constantly grows at 12%, the formula remains the same, but this time the D1 value will not remain $15 because the dividends are growing constantly at 12% every year. D1 itself will be 12% more than the D0 value. D0 was $15, so it will be $15 plus 12%, or you can also write as $15 into 1.12. Either ways, $16.8 will be your answer for D1. KE remains 20%. P0 is what you have to determine, and growth rate this time is 12%. So when you apply these calculations, P0 will be 16.8 divided by 0.2 minus 0.12. So the denominator will be the difference between KE minus G, and finally P0 value comes to 210. So did you notice the P0 value earlier was $75? Now it is $210. So what is the increase in value because of growth? It is the difference between these two values, and that comes to $135. This is basically the impact of growth rate on share value. So please write up this whole thing and then I take you ahead. Alright friends, so once you have completed this whole thing, let me explain one important aspect to you. What was the scenario prior to this? Dividends were not growing, so the growth rate was 0. So gap between KE and G, the gap between KE and G was wider. If the growth rate starts rising up, the gap between KE and growth rate becomes narrower. The narrower the gap, the smaller will be the value of the denominator in that formula, right? Look at this. It is D1 divided by KE minus G. So the shorter the gap between KE and G, the lesser will be the value of denominator and higher will be the value of the share. Are you people following me what I am saying? When I say this as 0, then KE minus 0 will remain 20% in the denominator. But if I say growth rate is 1%, KE minus G will be 20% minus 1%, that will be 19%. If growth rate is 2%, then denominator will be 18%. If growth rate is 3%, denominator will be 17%. If growth rate is 4%, denominator will be 16%. So as and when the growth rate starts getting higher and higher, the gap between KE and G starts reducing, and smaller the gap, the smaller will be the value of denominator in Gordon's model formula, and higher will be the value of the share. In simple words, the value of the share is directly related with the growth rate. The higher the growth rate, the higher will be the value of the share, which can be mathematically shown by connectivity between KE and G. Can I bring one more point of explanation over here for utmost clarity? Sometime back in your classes earlier, you have seen one thing, that KE is the aggregate of two components, dividend yield rate and growth rate. You remember the KE formula? KE equals to D1 by P0 plus G. D1 by P0, that ratio indicates dividend yield rate. Correct? Growth rate added to that becomes KE. So KE is aggregate of both components. So keep in mind one thing, KE is dividend yield rate plus growth rate. From KE, if I am subtracting the growth rate, can we agree that we get back to the dividend yield rate? So dividend yield rate in this example, 20% minus 12%, the dividend yield rate is 8%. So if the dividend yield rate is 8%, means you are going to earn 8% through dividends, and the amount of dividend is $16.8. Through dividends you are going to earn 8%, means your dividend income is going to be 8% of the value of the share. That 8% is $16.8. So how much will be the value of the share? The value of the share will be 16.8 divided by 8%. Now just imagine, if I increase the growth rate, this denominator value will become smaller. Why? Because if the growth rate rises, KE remaining same, the KE minus G value, which indicates dividend yield rate, will become smaller. If the dividend yield rate becomes smaller, with that smaller rate of dividend yield, if you are getting $16.8 or whatever dividend, then you capitalize that, you get much higher value of the share. So simple logic as a conclusion drawn from Gordon's model could be, as and when the growth rate in dividend goes higher and higher, the value of the share keeps on growing more and more. Now one thing that you should always acknowledge, the higher and higher growth, correct, would make growth rate to be at its max. To keep growth rate at its max, you need to pay lesser and lesser dividend, correct? Because if you are increasing the growth rate, it is outcome of what? Increase in the growth rate is outcome of what? The more and more return on equity you earn, and the more and more retention of earnings you have, because don't forget, as per Gordon's model, the growth rate is a product of two components. What two components? The retention ratio and return on equity. If you want to keep the growth rate at its highest, you keep your return on equity, but beyond a point you cannot increase the return on equity. So what is there in your hand is to adjust your dividend payout ratio. So you pay lesser dividend, you have more retention, and your growth rate will be higher. If you keep doing that, the lowest possible dividend payout ratio will be 0, when growth rate can be maximized. But what is the sense of the growth rate when dividend becomes 0? Because the model won't apply when dividends are 0. Keep in mind one thing, Gordon's model applies only to the companies that distribute dividend. So I'm sure you are clear with this whole discussion. Let us now move ahead with our next point of discussion, and that is stock with delayed dividends. Now what do we exactly mean by stock with delayed dividends? Please first understand this point. I'll give you time to write down the notes over here. See, imagine Gordon's model, just I explained to you, Gordon's model cannot be applied for companies that do not pay dividend. What if a company has decided not to pay dividend for a certain number of years, but thereafter it is expected to pay dividends, and from that point the dividends are expected to grow? For example, if you are the equity investors in my company and I declare one fact to you that, dear shareholders, I am not going to distribute any dividend for the next 3 years. The first time that you get dividend will be in the 4th year. But thereafter I will continue to pay dividends, and I also promise that dividends will grow. The company has declared that first time it will pay dividends from 4th year onward, and from that point dividends will grow. So dividends will grow maybe at a constant rate, but only from the point when the dividend is first paid. And in my example, the first time the dividend will be paid at the 4th year. Now use your common sense. As per Gordon's model, P0 is what? D1 divided by KE minus G, correct? P0 is D1 divided by KE minus G. if the first time dividend is paid in the 4th year, it is D4. But based on D4 value, you cannot determine P0 directly, but you can compute P3. You can compute P3. If P0 is D1 divided by K minus G, P3 will be D4 divided by K minus G. So you compute P3 value. P3 value will be the expected value of the share after 3 years, correct? P3 will be the expected value of share after 3 years. Then you discount that value to the present value simply, and that becomes P0. That will be your process of computation if the value of the stock is determined where initially dividends are not paid, basically dividends are delayed. So when dividends are delayed, this is the approach of calculation that you need to apply. So please write up these notes. When a company does not pay dividends currently but is expected to start paying them in the future, we can still determine the present value of its stock using Gordon's model adapted for delayed dividend payments. Using Gordon's model, calculate the value of stock just before the first dividend payment. This value is based on the expected future dividends growing at a constant rate. Since the calculated value or the calculated stock value is at a future date, discounted back to the present using the required rate of return. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move on to the next example, that will be example 2. Let us read this example. Dividend expected by end of 4th year is given as $16. Equity capitalization rate is 20%. You are required to determine the present value of the equity if the dividend per share constantly grows at 12% per annum. But the constant growth of 12% per annum will apply only when the dividend is paid, and the dividend first time is going to be paid in the 4th year. In such scenario, as I told you, to solve this question, what you will do, you will first determine the value of P3, correct? So you determine the value of P3 by taking D4 divided by K minus G. You define these variables. D4 will be the expected dividend receivable by 4th year end, that is $16. K is the equity capitalization rate given to you as 20%. P3 is the price of the equity share at the end of 3rd year, and G is the growth rate, that is 12%. Substitute the values to obtain the value of P3, and the P3 value comes to exactly $200. If P3 value is $200, find the present value of the share by taking the present value of this particular amount. So this is the future value, right? P3 still is a future value. The discounting rate is 20%. You bring it down to P0, which will be P3 divided by 1 plus Ke raised to 3, correct? P0 will be P3 divided by 1 plus Ke raised to 3. That will be $200 divided by 1 plus 0.2 raised to 3. Whatever be the calculated value will be your final answer. So finally P0 value comes to $115.74. So write up this whole thing quickly and then I take you ahead. Alright friends, once you have completed writing this entire solution, let us move ahead and now discuss something very important, that is capital asset pricing model, CAPM. Now throughout your journey in the field of finance, almost everywhere you will come across capital asset pricing model, be it the field of portfolio management, be it equity valuation, be it any level of your learning, capital asset pricing model will apply everywhere. Let me help you recollect. You would have learnt the concept of beta and how to determine beta. You know what is beta? Beta is a measure of relative risk. It relates risk of your stock in relation to the market risk. So your stock, when it is related to the market index, what is the degree of risk of your stock in relation to the market? That is expressed by beta. If beta is equal to 1, your risk is in parity with the market. If beta value is greater than 1, your stock has a higher risk as compared to the market index. If it is lower than 1, the risk of your stock is lower than that prevailing in the market. Now, what happens when you are going for application of beta? You apply beta primarily in this model known as capital asset pricing model. Why is this termed as capital asset pricing model? I am going to explain to you little later, but let us first write some important notes over here. I'll give you an equation of capital asset pricing model. You note down this equation, but the real essence of this equation I'll be able to explain to you through an example. So do the writing work first and then comes the explanation. Alright friends, once you have completed writing this entire equation and definition of these variables, let us start with the understanding part of this. Now this equation of CAPM, it fundamentally targets to arrive at a risk adjusted rate of return for an equity investor. It is a risk adjusted rate of return for an equity investor. So you start with a risk free rate, you add to risk free rate some risk adjustment. Now how do you make the risk adjustment? You take the difference between RM minus RF, that is the rate of return in the market, that is rate of return of the market portfolio, minus the risk free rate. That extra return that market portfolio is generating is called the premium. That premium is owing to the market risk. So what will be the premium owing to your stock? That you find by multiplying beta to that difference. As I said, the real understanding will be obtained when you take a calculative example to support this entire discussion, and we are sooner going to do that. So what I'll do is I'll take you directly to an example through which you understand this whole matter, and that will be example number 3. Now in this example, the risk free rate is given as 7%, rate of return in the market is given as 15%, beta of stock X is 1.2 times. Determine the expected rate of return on this stock using capital asset pricing model. Now what exactly you need to do to arrive at this calculation? First, conceptually understand this important matter. See, if you don't want to take any risk, then the risk-free rate that you will earn is just 7%. But if you are ready to take the risk, which is equivalent to the risk of the stock market, then you will earn 15% returns. Without risk, 7%, with risk, 15%. As a result, how much extra return you are earning because of taking the risk? That is extra 8%. That is called the premium. That premium you will be getting only and only if you are taking risk. However, 8% of that premium, that is 15 minus 7, 8% of that premium you will be eligible to earn only when you take the risk equivalent to that of market. What if you take still more risk? Then you should deserve a little higher premium. That is done by making the adjustment of beta. So beta is 1.2 times, correct? Which indicates that risk of your stock is 1.2 times of the risk prevailing in the market. So for the market equivalent risk, you deserve a premium of 8%. So for 1.2 times of the risk, the premium that you should be earning is 8% into 1.2 times. That would be 9.6%, correct? 8% into 1.2 times will be 9.6%. That 9.6% is the premium that you should get on your stock X because of its own risk. Now, premium is always over and above the risk-free rate. So 9.6% should be your premium and 7% is the risk-free rate. Add 9.6 to 7%. 7 plus 9.6 will give you 16.6%. 16.6% becomes your expected rate of return as per CAPM. Through the equation, if you try to adjust, you will get the same answer, and I am going to show you everything. First, what I will do is purposely I will put a detailed descriptive solution, and then I will help you with the application of that in the CAPM equation. So carefully take note of this descriptive solution first. In this descriptive solution, we start with the rates of returns information. Starting with the rate of return in the market as 15%, subtract risk-free rate as 7%, you get risk premium of 8%. An investor who is ready to invest in the market would expect 15% per annum returns, that is 7% as risk-free rate and 8% as premium for taking the risk prevailing in the market. Security X has a beta of 1.2. That means the risk associated with security X is 20% more than the risk prevailing in the market. Therefore, the investor will definitely expect a higher reward for such high risk, that is by expecting 20% more premium. Therefore, expected risk premium should be 8 plus 20%, that is 9.6%. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue further. Therefore, the expected rate of return as per capital asset pricing model will be 7% plus 9.6%, that will be 16.6%. So 16.6% is your final answer, but you cannot always go ahead with this kind of descriptive answer. You should always arrive at the shorter approach by using the formula or the CAPM equation, that is this one. So the variables over here, ERX is the expected rate of return on security X as per CAPM, RF is the risk-free rate, RM is the rate of return on market index, and beta is the beta factor for security X or stock X. So now when you put up all these values, what we have seen in this equation, then RF will be 7%, RM minus RF means 15 minus 7. So 15 minus 7 within brackets, what you get is 8%. 8% into beta as 1.2. 8% into 1.2 will give you 9.6%, and that added to 7% will give you ultimately 16.6%. Look at this. This will be the application of beta for CAPM. So please write up all these calculations and then I take you ahead. Alright friends, I'm sure you have completed writing this as well. Now, the most important point of discussion. Once you have understood how to apply CAPM equation and arrive at the expected rate of return. But guys, that is just the partial application of CAPM. It's not the complete application. CAPM, ultimately, it is capital asset pricing model. This model is used for determining the value of the share, correct? Because it's a pricing model. Pricing of what? Obviously, we are talking about that same equity stock that you are discussing. So how would you use this information, what we have extracted over here, to determine the value of equity? It is very simple. The application of this gets extended to what we call as equilibrium price. Note that term, equilibrium price indicates price of the stock that should prevail in the market as per the expected rate of return revealed by CAPM. In other words, it will give you the fair value of the stock. But how do you arrive at that? So you can use Gordon's model, which is P0 equals to D1 divided by KE minus G, What is KE over there? Tell me, what is KE over there? KE over there is nothing but the expected rate of return by the equity shareholder. So that KE, if you are extracting from CAPM, because this is also giving you expected rate of return by the equity investor, correct, which can be resembled as KE. If this KE is substituted in Gordon's model and then you compute P0 as per Gordon's model, that precisely becomes the fair value of the share, which is an outcome of Gordon's model. But before applying Gordon's model, the expected rate of return by the equity shareholder has been obtained through CAPM equation. That is where we introduce this important terminology, that is equilibrium pricing. So equilibrium pricing itself means that you can use Gordon's model or maybe any other model for determining P0 value, but the KE over there necessarily is derived from CAPM. So let us understand the application of CAPM over equilibrium pricing through the next example, that is example number 4. Let us read this example. Messrs X Limited has paid dividend of $2.5 per share in the current financial year. The details are as follows. Now first thing, when they have paid dividend of 2.5 per share in the current financial year, means this is D0, correct? Current market price of the share is given as $60. Growth rate in earnings and dividend is given as 10%. Beta of the share given as 0.75. Average market return given as 15% and risk-free rate of return is given as 9%. Calculate the equilibrium price of the share. Now keep in mind one thing, what we are computing will be the equilibrium price, and this is the quoted market price of the share, correct? We can then compare the quoted market price with the computed value of equilibrium price to see whether the stock is fairly priced or underpriced or overpriced. So let us look into how to present the solution for this example. In your solution, you will first apply CAPM equation and you will determine the value of KE through this equation. Now the expected rate of return by the shareholder itself is resembled as KE. So when we substitute all the values available, we get the KE value as 13.5%. Before I take you any further, please write up this much quickly. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. Now we put up the Gordon's model formula, that is P0 equals to D1 divided by KE minus G. We define the variables over here. D1 will be the expected dividend receivable by year end. So current dividend was $2.5. With 10% growth, the expected dividend for the next year or by end of the year, it will be 1.1 times of $2.5. The KE is the equity capitalization rate, which we have derived through CAPM, that is 13.5%. P0 is the equilibrium price of equity share that you have to determine, and growth rate is given as 10%. So when you apply all these calculations, the P0 value that you get will be 2.75 divided by 0.035, and P0 value is $78.57. Do you know one thing? The quoted market price of this stock was $60, correct? And if $60 is the quoted market price, whereas the fair value or the equilibrium price should be $78.57, it is definite that the stock is underpriced, and when there is an underpriced stock, it is always worth making investment into that, means this stock is worth buying. So I'll just give you time to note down this solution and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move on to the next example, that is example number 5. It says dividend expected by end of the year is $12. Equity capitalization rate is given as 25%. The present value of the equity is given as $80. You are required to determine the implied growth rate. So basically this is nothing but the reverse calculation kind of example. So you know how do you determine P0 value? P0 is D1 divided by KE minus G as per Gordon's model, correct? Look at one thing. Growth rate information is missing over here. P0 value is already given to you as $80. D1 is given as $12. KE is given as 0.25 or 25%. So you put the values which you are knowing in the Gordon's model formula, and the missing value, that is the growth rate, will then be obtained out of that, which is termed as implied growth rate. So implied growth rate you can easily determine through Gordon's model. So let me show you how to present the solution over here. In your solution, you are just going to write the present value of share as per Gordon's model, P0 equals to D1 divided by KE minus G. You define these variables. P0 is the current price of the equity share. D1 is the expected dividend receivable by year end, that is $12. Expected rate of return KE is 25%, and G over here is not a known growth rate but the implied growth rate. When we substitute all these values in the Gordon's model, we get $80 equals to 12 divided by 0.25 minus G. Now look at one thing. What is the missing value over here? Growth rate is the only missing value, correct? If growth rate is missing, you can determine the growth rate, correct? You can determine the growth rate through this equation. Now how will you solve this? Simply cross multiply, and what you get, 0.25 minus G equals to 12 by 80, and 0.25 minus G will give you 0.15. So G will be 0.25 minus 0.15, and that gives you 0.10 or 10%. So it is clear that the implied growth rate is 10%. So please write up this whole thing. That will be end of this solution as well as end of this session.